Today's episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, on Wednesday, we saw wheat, soybean meal finish with a little bit of strength. The corn market just kind of chopped around unchanged, and mixed activity in livestock and an overall quiet day, it felt like, in the ag trade. We're going to discuss that and more. Joining us today, our good friend Mike Zuzolo, Global Commodity Analytics, is with us. And Mike, good to have you back on the show, sir. And I made the comment to you. It felt like I made the comment off air. It felt like watching paint dry in the market a little bit on Wednesday. Just a fairly quiet day with not a ton of news headlines to drive us.
No, we had those early export sales reported for both corn and beans to unknown destinations, Jesse, and it seemed like those export sales really stuck to the wall in the price action in the soybean complex. But the corn actually, after going up and testing and going through its 200-day moving average by just a smidge in the March contract, then started to sell off late in the session. Two things I think were driving that later trade in the corn. The first one was probably an updated private weather forecast about Argentina, talking about early February turning back off hot and dry, and how that would probably hurt the bean production the most versus the corn. Now, I have to kind of qualify that and say the corn production's probably been decimated at this point. So, yes, there's more to lose in soybeans. And so if you look at it from that perspective, I do think that maybe created an environment where those people who had been buying corn and selling beans earlier this week maybe wanted to reverse that spread trade because that South American weather all of a sudden turned better. But I think the biggest thing that turned the corn lower was late in the day, news wires throughout the ag ministry from Mexico, one of their key ministers saying that he wanted to, and Mexico wanted to cut corn imports by 30 to 40% by 2024. And I think those headline-driven things on a day, as you say, kind of like a low volatility, paint drying type day, they seem to make a bigger splash in the pond.
They definitely do. Well, I know there's a lot of things in the forefront here that we want to take a look at today. And I want to talk how the economy is weighing into things. The U.S. dollar, I know there's some concerns on Wall Street here with different economic reports coming out this week, et cetera. You provided a chart for us here. This is a dollar index and the Deutsche Bank Ag Commodity Index. So I know we've seen this chart from you before. We've been following along with it a little bit. What's the latest you're seeing as you take a look at how these two are acting together, the relationship here, Mike?
Yeah, great question. To just do a little bit of a review, if you go back all the way to the beginning of the chart right after the financial crisis in 2009, you notice these two assets started to develop a very strong negative relationship with one another. And so with the dollar staying low from 2009 to mid-2014, you had a lot more up in the Deutsche Bank Ag Commodity Index. Commodity Index ETF is mainly what they trade in that. But then as we started to see the dollar go higher in 2014 and then really launch up to another level in 2015 and then 2016, you see this general slide in the DB Ag Commodity Index. And that's where the trade started to get into more of a deflationary mindset. And then in 2020, they both started to go up together. So that strong negative relationship with one another, which made sense because emerging markets and commodities are often associated with one another. And if the dollar's going down, that tends to help emerging markets, which tends to help commodities. All of a sudden in 2020, they both found a bid for different reasons. And I think now that we're in 2022, with the Fed rate hikes getting ready to maybe get more neutralized next month, and we'll get an update from them next week on the 31st and on the 1st of February, we're still waiting with that big decline in the dollar. That's the orange line. Notice how that 101.50 level, Jesse, gets us back to the top end of the range traded in the highs of 2015, 2016, and 2020. So we've had a big break in the dollar index. My 2023 analysis that I'm doing for my upcoming webinars and seminars is a range-bound dollar, that there's very few reasons to choose the dollar as a safe haven again, especially if the Federal Reserve lets off the gas pedal. And that should help bring this agriculture commodity index in purple back around. So we've had a big break in both, but what we should start to see if we have more of a normalized market is if the dollar stays weaker, that purple ag commodity index should start to turn higher, and it's starting to just a little bit right now, and I think that means a lot to the wheat especially.
Well, I know you bring up wheat, and that's a good point to maybe stay on here, because obviously with these wheat markets, I've heard a lot of talk about a lot of short positions by fund managers in the wheat markets right now. I wonder if we continue to see the dollar remain weaker, if we get some sort of short covering rally, what that could do to these wheat markets. And throw on top of that, I've lost sight of the Black Sea region. We got reports of a Turkish vessel being hit by a missile on Wednesday. So it seems like there's a lot of things in this wheat market to kind of go along with that chart you showed us here as well that really we need to keep an eye on, it feels like.
Yeah, I mean, the soft red wheat net short position by managed money funds in the Commitment to Traders report for both futures and options is at its biggest net short since 2019, since mid 2019. And that is pretty clear that the reason for that was A, the dollar was rallying, B, the funds did not decide that the Russian war was going to get worse and the Baltic situation was going to get worse, and they could take out risk premium in part because of big Russian stocks and big Australian stocks. I think that's all being reevaluated. And you're right, this missile strike is part of a larger narrative of Abrams tanks now going to Ukraine, heavy armor from a NATO nation, Germany sending Leopard 2 very high level tanks, again, a NATO nation sending heavy armament into the Ukrainian war. And I think this really opens the door, like we've talked about a lot of times, to the idea of an escalation and a broader based war that the market has not kept that risk premium in. And, the USDA already told us in their last wheat outlook and their grain outlook that the corn acreage base in Ukraine was going to be down at least 20% this upcoming year. I don't think the trade's really gotten their hands around all of that yet, but I think maybe with some of these things happening now, in specific areas of Germany, U.S., NATO allies jumping into Ukraine, and also the potential for Turkey, who was a friend of Russia, to potentially have a strike on one of its vessels, really throws out the issue that maybe Russia is seeing themselves as a lone wolf at this point and will do maybe anything they have to stay alive as long as they have to. And I think that's the way Vladimir Putin operates. It's not a surprise. He's been that way his whole political life, going all the way back to taking out Boris Yeltsin from the leadership position of that new federation, that new Russian Federation after the fall of the Soviet Union. So I will beat the drum again and say they just don't have enough weather premium for the hard red wheat belt, and they certainly, in my opinion, don't have enough risk premium for the geopolitics that we're probably going to face the next 60 days.
Well, and that comes back to the thought that I know you've had for quite some time, as you mentioned, kind of beating the drum, wheat being an upside leader, and how these grains need wheat to be the upside leader to help us break through some of that overhead resistance. And I, watch soybeans towards the bottom end of their downtrending channel, corn choppy. So I think it all kind of circles itself back there, Mike, to the fact that, wheat needs to be the upside leader if we want to bust out of some of these ranges we've been in.
Yeah, that's exactly right. And I think I'll throw one more thing on top of that. I'm looking at all my 2023 acreage base numbers that I've now developed. Mm-hmm. And if we have 48 to 40.5 million acres of all wheat, and we keep a decent demand base because of a dollar that's locked into more of a channel, we can't really build the carryover here in this country, Jesse. And so it really, I guess, as I said to someone else today, maybe my price analysis that I do on my spreadsheets that suggested a 570 or 580 carryover, soft red wheat should be closer to 950 instead of 750. maybe that's not right, but I do think that it's probably going to end up being right that we really are in deep undervalued territory and have taken premium out. So much like the hog complex right now, I think the wheat complex is one of those situations where if you have to sell, be very prepared to re-own it if you get some strong buy signals. Buy signals. That buy signal to me, the first one would be, now that we've gotten back up to last week's levels, can we take out last week's highs on a weekly basis? And I think that would be indicative of a long-term trend line and sentiment change in this market that you maybe want to get some re-ownership on the books.
Mike Zuzolo with Global Commodity Analytics is our guest here today on the show. Mike, one other thought, the soy complex feels like it's largely in a weather market, a South American weather market right now to an extent. I know we were talking a little bit about some better weather models coming out here for Argentina and Brazil that might be a little bullish to beans, might have gave us a little bit of that strength, but just feels like we're trading weather for the most part here in this soy complex as we kind of move forward with a lack of other news to trade off of.
Yeah, we still have that gap above the chart in the meal in the weekly chart around 492. So about $30 a ton higher than where the March is about sitting after today's close. We still have a July Nove bean spread that's trading about $1.40 premium to the July, which traditionally would suggest we don't have enough supply to meet demand, and we're trying to pull the supply forward to meet the near-term demand. Those are both very strong elements to what we need at this point, because I think I've seen a change, Jesse, in the way the market for soybeans has traded, and it's been from going to buying dips to selling rallies, especially since that last WASI report. Now today, on Wednesday, was a noted exception. We had the soybeans in the March go right back down and test its 50-day moving average and bounce like a ball, and all of a sudden we see a close back above $15. Very welcome, very needed news to keep the sentiment from getting too negative in the soy complex. So that's kind of, I'm neutral on soybeans. I'm not a long on soybeans. I'd probably rather be a long in the meal market, because I think that's what's going to have to drive the bus, especially given that we've got an Argentine weather problem much more than a Brazilian weather problem. And so I don't like the fact that Brazil's export price for beans is in the 15s and we're still above 16 at the Gulf. So that's kind of how I see the beans right now.
And real quick, corn as well. I know we touched on a few things corn-wise. Anything else on those charts there that you're keeping an eye on, Mike?
Yeah, the same with the corn. I mean, the 50-day moving average is extremely important, especially now that we've tested the 200-day moving average. And if we can plow through the 200-day moving average with wheat leading especially, I'm going to assume, like I have been, that the dollar is weak and the crude oil is strong. And then that gives us, I think, the opportunity to maybe stretch our legs up towards that 690, 695 level. But I think that the timing of that probably needs to be relatively soon.
Mike, let's flip over to livestock and let's talk hogs. This hog market, it's just been a rough go of it as of late. We've talked about it, and I want to touch on it again. I'm wondering if when we're gonna find that bottom in this hog market. And a fairly choppy day, Wednesday. We got another chart up on the video screen, the lean hog index with the lead month hog futures. Walk us through what you're seeing here and just some of the latest trends you're seeing here in this hog market right now.
You know, this chart is really interesting, Jesse, because obviously the lean hog index is the key to, because the futures has to match up with the index by the time a futures goes off the board. But in between that futures expiration, they can diverge, and I think that's an important thing to be watching for. And what we see all the way since January all the way to December is a market where both of them have followed each other and been in a very strong trend with one another. But then in December, the hogs tried to go higher. And I think that was the Chinese buy, that they're coming out of zero COVID. Let's buy it with both hands. But notice the cash index did not blink. It actually made new lows going into Christmas. And it tried to bounce with that top in the futures market in purple, but the cash index was going nowhere. In fact, it was setting up for another leg lower. So what's the root cause of that index going lower? And that is the pork cutout. So we've got the pork cutout now at about $80. That's a very strong support level going back to 2021. But if we take that out, then we could go back down to 65.70. That's your 2020 lows from like the third and fourth quarter. My take is this: if we can get a low in the cutout, we can get a low in the cash index. And as the February hogs go off the board, it might just be time to step in and re-own or buy some April hogs because this break that we've seen has been so severe. That would also match up with the idea that by the time we get to the end of March, I think China will be back in terms of economically and finding maybe a little bit more demand for their pork again from the foreign markets. So that's kind of I really enjoy it when these markets go opposite one another, when they should be following one another, and then try and figure out what's the most likely thing to bottom. And I think it should be that cutout.
Well, and I wonder too, thinking about the retail demand here in the U.S. when it comes to on the hog side, compared to beef, compared to chicken, compared to eggs. I mean, pork is cheap. We got a lot of pork out there, though, to chew through in cold storage, et cetera, and in the store. So I wonder, too, if, more people go to the grocery store, start buying pork, if we start to get, pork off the shelves by the time we get to, say, you mentioned March, April, et cetera. Wonder what that would do to this hog market potentially.
Yeah, I think that works really well with the idea that the cutout can find some support, because you're right, the high quality cuts are really cheap. I've been eating a lot of tenderloin, boneless tenderloin, and getting a decent piece for $2.50 a pound, a really nice piece for $3.50 a pound, and it cooks very quickly. I think if most consumers are like me, who are feeding 5 to 6 at a dinner table every night, they're really jumping on the pork, and especially with high egg prices too. You've got to get that protein substituted somehow, and it seems to me that in 60 days we could consume and chew through a lot of good quality pork at a very undervalued price. So that is kind of what sets up that cutout value, finding a low. And if the bacon prices would take another dip down, I think they too would start to attract some price action and some demand. But we've got to realize that the bacon is closely attached to the egg prices, especially this time of year when we don't have tomatoes on the vine. So that's another part of an element of this market that probably many of us didn't think about. If egg prices are high, we're not going to eat as much bacon.
I was going to say, bacon prices would come down. I'd eat more bacon. That's for sure. Put a little more in my daily diet. Right. Cattle market, cattle on feed report last Friday, relatively in line with expectations. It seemed like, call it fairly neutral considering what the expectations were, which is still fairly bullish overall. Your take on the cattle on feed report and just the general, I'll say, quietness of the cattle trade so far this week?
Yeah, quiet, especially when it comes to the cash market. And it seems to me that with the non-commercial funds at 93,000 net long right now, and still upwards of 1 year highs in terms of how long they are the live cattle market, I think they are waiting for some good cash news or something to be able to drive their price trend, because it's very quiet in cattle. The feeders are very closely associated with the corn and moving opposite the corn most days. And then we've talked about the hogs, and there's no real foothold in the hogs yet to be able to say, let's buy cattle. In fact, the cattle hog spread breached $80 today. And yesterday, the feeder fat cattle spread, the Jan feeders minus the fed fat cattle, got down to $21. That was a new contract low. So when you look at cattle in relationship to the spreads against hogs and feeders, they have a terrific premium in them right now, Jesse. And I think that's why the market needs to get some cash news. I think cash can pick up. I think we're a little short bought at the packer level. I think the colder weather will attract some packer attention, and I think the bids may perk up here as we get towards the end of the week. But I'm still not sure we don't have a premium being built into the April market, and I've actually started to step in and get a little bit of hedging done in that April at 161.50 plus.
Well, Mike, before we wrap it up today and run out of time, any final thoughts you want to share with us?
No, I think we've hit everything. I just appreciate you having this program, Jesse, and I'm sure a lot of people appreciate the information that you provide them, and I really thank you for having me on.
Of course. Well, I know you're always a wealth of knowledge, and we appreciate it too. And I know if folks want to reach out to you and get some marketing advice and talk research and more, I know website, phone call, a lot of ways to get in touch with you, isn't there, Mike?
Yeah, and I would really encourage you to try and sign up for a trial and then try and extend yourself to when I start putting some of these 2023 Outlook webinars up on the website. So go to globalcomresearch.com, sign up for the trial, or give me a call at 866-471-2588. Quite a few people have been calling in. I appreciate that, and keep calling and try and answer your specific questions.
Globalcomresearch.com is how you could find him. Mike Zuzolo, Global Commodity Analytics. Always a pleasure, sir. Enjoy the rest of your week. We'll talk to you next week.
You too, Jesse. Thanks again.
That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.